Hello there, and welcome to the Sleepy Music Wealth Stories. Tonight we are tracing the long and remarkable history of the stock market, a story that begins not on a gleaming trading floor or a screen full of numbers, but in the narrow streets of ancient port cities where merchants weighed risk against hope and decided to share the burden of chance. Music, we begin in a world where goods moved by ship, where a single voyage could make a family wealthy for generations or destroy everything, and where the only hedge against ruin was to find someone else willing to share the gamble. The stock market, as we now know it, is just a few centuries old. Music, but the ideas underneath it: ownership divided among strangers, profit shared according to contribution, risk distributed so that no single person bears too much. These ideas are ancient. They surface in the clay tablets of Mesopotamia, music in the contracts of Roman merchants, in the back rooms of Italian banking houses, and on the wind-whipped docks of Amsterdam, where a single company changed the world by inviting ordinary people to buy a piece of it. What makes this history worth telling slowly, worth sitting with, is not the numbers. Music, the numbers are just symbols. What makes it worth telling is what the numbers represent: the anxiety of a merchant watching the horizon for a ship that may never return. Music, the hope of a weaver in Holland who poured her savings into something she could not see or touch or hold. The grief of families ruined in a single afternoon when the market turned. Every chart has a human story beneath it, and music, those stories stretch back further than most people imagine. In the centuries we're about to travel through, you will meet Venetian bankers and Dutch speculators, music, English coffeehouse gamblers and American railroad barons, financial visionaries who built systems that endured and dreamers whose schemes collapsed in spectacular ruin. We will follow the slow invention of an institution that now moves more money in a single day than most ancient empires ever accumulated music in their entire history. You will watch the market grow and crash and reform and grow again, because that is what markets do. They are not machines. They are conversations between strangers about what things are worth. Music. And tonight, with your eyes growing heavy and your body easing into rest, that conversation begins. If you enjoy these gentle journeys, I invite you to like, subscribe, or share a thought below. It helps others find their way here too, one sleepy music soul at a time. But for now, let your shoulders soften and your breathing slow. Let the day loosen its grip and allow your thoughts to drift back through time as we explore the long and remarkable music history of the stock market. Let's begin. Long before there were stock markets, there were voyages, and long before voyages, there was the question of who would pay for them. In the ancient world, wealth traveled by water. The great civilizations that rose along the Tigris, the Euphrates, the Nile, and the Mediterranean were river and sea civilizations, and their commerce depended entirely on boats, fragile wooden things that could be swallowed by a storm without warning. Music, a merchant who loaded his entire fortune onto a single vessel, was not just doing business, he was gambling. And the more he understood about the sea, the more he understood that the gamble was not always fair. Music, ships sank, crews mutinied, pirates waited in certain straits and certain seasons, cargo rotted, winds shifted. The first great insight in the long history of shared investment was not about profit at all. It was about loss. Music, if a merchant could convince even 2 or 3 partners to each take a share of a cargo, then the loss of that cargo did not mean ruin, it meant a bad season that could be survived. And if the cargo arrived safely, music, the profit could be divided. Everyone got a little less, but everyone could afford to try again. That bargain, simple as it sounds, is the foundation of every stock market that has ever existed. The clay tablets of ancient Mesopotamia record transactions that would not look strange to a modern accountant. Music. Merchants in Ur and Babylon, writing with reed styluses on wet clay around 2000 BCE, recorded loans made against the expectation of future harvests, partnerships formed to fund trading expeditions, and agreements about how profits would be divided when the goods returned. Music, some of these agreements are remarkably specific: this much silver for this many bolts of cloth, repayable in grain at this rate when the harvest comes in. Others read more like what we would call equity arrangements. One party provides capital, another provides labor and expertise. Music, and both share in whatever results. Code of Hammurabi, inscribed on a stone pillar around 1754 BCE, included provisions for exactly these kinds of arrangements. Music, Hammurabi understood that commerce needed rules, that a lender and a merchant could not both prosper if there were no shared understanding of what each was owed when things went wrong. The law carved into that pillar set terms for loss, for default, for the responsibilities of agents who carried other people's money across dangerous distances. Music, it was, in its way, an early attempt to make financial partnership predictable enough that people would be willing to try it. Ancient Greeks, who maritime traders of extraordinary ambition developed a financial instrument called the bottomry loan. This was a contract in which a lender advanced money to a ship's captain for the purpose of a voyage. Music, if the ship returned safely, the captain repaid the loan at a high interest rate, sometimes 20 or 30% or more depending on the route and season. If the ship sank or was captured, the debt was canceled. The lender lost everything, but the captain lost nothing beyond music, the voyage itself. It was not equity. The lender did not own a piece of the cargo, but it was risk-sharing in the purest sense, a wealthy individual bearing the financial exposure so that a skilled sailor could sail without fear of lifelong debt. Music, these loans were negotiated in the Agra, announced publicly, and sometimes transferred between lenders before the ship even returned. The Romans took these ideas and gave them institutional form. The Roman Empire ran on contracts, and among the most interesting of those contracts were the arrangements of the publicani, private companies that bid for government contracts. Music, the Roman state needed roads built, taxes collected, temples constructed, armies supplied. Rather than managing all of this itself, it auctioned these tasks to associations of private investors who pooled their resources, divided the profits, and took on the risk of execution. Music, historians believe that shares in these associations, called parts, could be bought and sold, and that their prices changed depending on how well the company was performing. Some scholars point to passages in Cicero's writings that suggest parts were actively traded in the Roman Forum, music, making it one of the earliest known examples of something resembling a secondary market for ownership stakes. Rome did not last, and neither did its financial infrastructure, music. When the Western Empire fell in the 5th century, the sophisticated commercial networks that had connected Britain to Egypt, Spain to Syria, all began to contract and fragment. Music, long-distance trade did not vanish, but it simplified. The great markets shrank. Complex financial instruments, the loans, the partnerships, the transferable shares mostly disappeared, preserved only in legal texts that scholars would rediscover 1,000 years later. For several centuries, the dominant institution was not the merchant but the monastery, music, and the dominant financial question was not how to share profit but how to obey the church's prohibition on charging interest at all. The merchants of medieval Italy found ways to bend that prohibition without quite breaking it, music. Venice, Genoa, and Florence sat at the crossroads of the medieval world. Goods from Asia, spices, silk, dyes, precious metals, moved through their ports on their way to northern Europe, and the merchants of those cities grew rich by controlling the flow. Music, but controlling the flow required capital, and capital required lending, and lending required interest, and interest was officially condemned by the Catholic Church as usury. The Italians were created. They invented instruments, the bill of exchange, the commenda partnership. The insurance contract that accomplished the same economic purposes as loans with interest, music, but were structured just differently enough to satisfy the letter of religious law, if not always its spirit. The commenda was particularly important, music. A wealthy investor called the commendator would provide capital for a trading voyage. A traveling merchant called the tractator would carry the goods and conduct the actual trade. Music, the tractator risked nothing but his time and labor. The commendator risked the capital. When the voyage returned, profits were divided, typically 3/4 to the investor, 1/4 to the merchant, and if the ship was lost, the investor absorbed the loss alone. Music, this arrangement allowed capital to travel in the hands of someone who knew the markets, while the person with the money stayed safely at home. It was a clean division of financial risk from operational risk, and it powered the growth of Italian trade for centuries. The Medici family discovered that money lent across borders could buy power that armies could not. In 15th century Florence, a family of wool merchants began to do something that made their neighbors nervous. Music, they kept meticulous records, in columns and ledgers that tracked not just gold but obligation, reputation, and risk. By the time Cosimo de' Medici took control of the family bank, music, it had branches in London, Bruges, and Rome, each one a node in a network that moved money quietly across borders where armies could not follow. Their instrument was the bill of exchange, a written promise that a debt in one city could be settled in another without physically moving coin. Music, it sounds simple until you realize what it replaced. Before this, moving wealth across long distances meant wagons, guards, bandits, and the constant risk of loss. A letter in a courier's bag changed music, all of that. The Medici could fund a war in one kingdom and collect the interest in another, never touching gold at all. What made their power so durable was that they became indispensable. Music, popes borrowed from them, kings owed them favors, and because they tracked every obligation with care, music, they always knew exactly how far a borrower had stretched. The Medici did not conquer Florence, they simply made themselves impossible to remove. In the cities of Northern Europe, a different kind of financial culture was taking root in the trading halls of the Hanseatic League. Hanseatic League was a confederation of merchant cities, Lübeck, Hamburg, Bremen, Danzig, and dozens of others, that dominated trade across the North Sea and the Baltic for nearly 3 centuries. Music, these were not cities of philosophers or artists. They were cities of merchants, and their culture was built around the careful management of commercial relationships. The League created a shared legal and commercial infrastructure music across political borders that were otherwise hostile. Standardized weights and measures, legal protections for member merchants in foreign cities, a network of trading houses called Konter that gave Hanseatic merchants a foothold in London, Bruges, and Bergen. What the Hanse merchants understood was that trust was a form of capital. Music, a merchant known to honor his contracts could borrow more cheaply, secure better deals, and survive setbacks that ruined less reputable traders. The League enforced that trust collectively, blacklisting members who defaulted on obligations and protecting those music who behaved reliably. In this way, they created something like a credit rating system 600 years before any modern bank thought to formalize the idea. The joint stock company was born from a problem that no single merchant could solve alone: music. By the 16th century, European nations were in a race to establish trade routes to Asia. The problem was scale. Music, a voyage to the Spice Islands, modern-day Indonesia, required not one ship but a fleet. It required months of provisioning, highly skilled navigation across waters no European had charted, armed protection against pirates and competing nations, and the patience to wait years for any return on investment. Music, no single merchant, no matter how wealthy, could fund this alone without risking total ruin if the fleet encountered a storm or a hostile navy. The solution, developed most fully in the Netherlands, was the joint stock company, an entity that pooled capital from many investors, gave each a proportional claim on the company's profits, and protected each individual from unlimited personal liability. Music, if the company lost money, an investor lost their investment, but nothing more. Their house, their land, their other assets were safe. This protection, what lawyers would later call limited liability, made it rational to invest in ventures that no one would have risked with personal fortune fully exposed: music. The Dutch East India Company, founded in 1602 and known by its Dutch initials as the VOC, became the first company to offer this arrangement to the general public: music. The VOC was chartered by the Dutch government to conduct trade in Asia, to buy spices, textiles, and other goods at their source, and sell them in European markets at prices that could sustain the enormous costs of the voyage. Its charter gave it monopoly trading rights across a vast region: music, the authority to make war on behalf of the Dutch Republic, and the power to establish colonies and sign treaties. It was not simply a commercial enterprise. It was, in many respects, a sovereign power clothed in the language of commerce: music. To fund itself, the VOC did something unprecedented. It issued shares, pieces of ownership, that any resident of the Dutch Republic could buy, not just wealthy aristocrats or established merchants. Any person with enough guilders and the willingness to wait for a return: music, could become a part owner of the most powerful trading company in the world. Workers, craftsmen, widows, and clergy, records show that the initial subscribers came from every layer of Dutch society, drawn by the prospect of a return on money that would otherwise sit idle. Music, the total raised in the initial subscription was more than 6 million guilders, an extraordinary sum for the time. What happened next was not planned: music. Once people owned shares in the VOC, some of them wanted to sell those shares, either because they needed the money back, or because they thought the price might fall, or simply because they had found something else they wanted to buy. And other people wanted to buy those shares. Music, very quickly, a secondary market developed, a place where VOC shares changed hands between investors, at prices determined by supply and demand rather than by the company itself. This was not something the VOC's founders had designed. It emerged spontaneously, music, from the simple fact that ownership could be transferred. The place where this market took root was the Bourse of Amsterdam: music. The Amsterdam Bourse, or exchange, opened in 1611 in a building on the Rocken that resembled a covered arcade. Music merchants had been meeting informally in the open air for years before this, in the streets and on the bridges of Amsterdam in all weathers, but the Bourse gave them a dedicated space, regular hours, and an implicit social contract about how business should be conducted. Music, hundreds of merchants gathered there each day to trade not just VOC shares, but the full range of commodities that Amsterdam's global trade economy produced: grain, herring, cloth, sugar, spices, and the financial instruments, bills of exchange, insurance contracts, forward agreements that supported them. The trading of VOC shares at the Bourse quickly became more sophisticated not only buy shares and hold them waiting for dividends. He began to develop new instruments for speculating on future price changes. One of the most important was the futures contract, an agreement to buy or sell shares at a specified price on a specified future date. Music: if a trader believed the price of VOC shares would rise, he could agree today to buy them next month at today's price, and then sell them once they had risen. If he was right, he profited without ever having to hold the shares at all. Music: these instruments, called time bargains or term trades, allowed traders to take positions on price movements using far less capital than would be required to actually own the shares. A man named Joseph de la Vega wrote the first ever book about stock market trading in 1688, and he called it Confusion of Confusions. Music. De la Vega was a Portuguese Jewish merchant who had settled in Amsterdam, and his book, written as a dialogue between a philosopher, merchant, and a shareholder, described the Amsterdam market with extraordinary precision and wit. Music: he explained how prices move, how rumors spread, how operators with large holdings could manipulate the market by carefully timing their trades, how novice investors were repeatedly parted from their money by those who understood the game better. He described bull markets and bear markets using different language, but meaning exactly the same things we mean today. Music: he wrote that the exchange was a place where every man appears in the market full of expectation, and most of them will be disappointed. The market he was describing was already within a century of its founding, recognizable as something very close to what we would call a modern stock market. Music. England was watching and learning, though it would take a spectacular disaster to teach the English the most important lessons. Music. By the late 17th century, London had its own informal markets for trading shares and financial instruments. The preferred setting was not an exchange building but a coffee house, and the most important of these was Jonathan's Coffee House in Exchange Alley near the Bank of England. Music: Jonathan's was where brokers and jobbers, the people who matched buyers with sellers, and those who traded for their own account, gathered to conduct their business. The atmosphere was chaotic and social, music full of tobacco smoke and argument, prices called across the room, handshakes sealing deals that would move significant sums of money. It was not yet an organized exchange, but it had the energy of one. The Bank of England itself had been founded in 1694, and its establishment was part of a broader expansion of financial activity in London. Music: new companies were being formed in England with increasing frequency. Companies formed to drain swamps, to manufacture glass, to trade with Africa, to insure ships. Some of these were serious enterprises, many were not. Music: the decade around 1720 would show, in the most brutal way possible, just how badly things could go when enthusiasm for financial innovation outran the capacity for sober judgment. The South Sea Company was established in 1711 with a grand promise it could not keep: music. The company was chartered to conduct trade with South America, then dominated by Spain, and to manage a portion of Britain's national debt. The trade never really materialized, music, because Spain controlled the ports and had little interest in accommodating English merchants. But the company's directors were less interested in actual trade than in the financial opportunity created by the arrangement with the government debt. Music: over time, they began to promote the company's shares with increasingly extravagant promises. Profits from mythical trade routes, returns that no realistic business could generate, music: connections to political insiders who would ensure the company's success. The directors deployed every tool of persuasion and rumor available to them. The public, hungry for investment opportunities in an era of expanding wealth, responded with enthusiasm that quickly became mania. Music. In the spring and summer of 1720, the price of South Sea Company shares rose from around £100 to nearly 1,000, a tenfold increase in a matter of months. Music: everyone wanted to participate. Members of Parliament bought shares, noble families put family fortunes into them. Isaac Newton himself invested, watched the price rise, sold for a profit, and then, tempted by the continued climb, bought back in near the peak, eventually losing £20,000, music, which today would be worth millions. He reportedly said afterward that he could calculate the motions of the heavenly bodies but not the madness of people. The madness when it broke was devastating, music. By September 1720, the price had collapsed back below £300. By December, it was barely worth the paper the certificates were printed on. Music: thousands of investors, from powerful aristocrats to ordinary tradespeople who had borrowed to buy shares, were ruined. Parliament launched investigations. Several directors fled the country, others were imprisoned. Music, the government scrambled to manage the fallout, restructuring the debt and trying to limit the damage to the broader financial system. The South Sea Bubble, as it became known, left a mark on English attitudes toward finance that lasted for generations. The Bubble Act, passed in the same year, made it nearly impossible to form a joint stock company in England without a specific act of Parliament. Music. This was, in effect, a regulatory overreaction, the financial equivalent of banning all knives after someone had been cut. For over a century, music English law was deeply suspicious of the corporate form that had proven so useful in Amsterdam. Companies still formed, investors still traded, markets still functioned, but the institutional development that might have accelerated instead stalled. Music, the Amsterdam model, which could have been adopted and improved upon, instead became a cautionary tale cited by those who distrusted financial innovation. And yet financial innovation does not stop. It slows, shifts, and finds new channels. Music. In France, around the same time as the South Sea disaster, a Scottish economist named John Law was running an experiment so audacious it is still difficult to comprehend. Music, Law had convinced the French regent, Philippe II, Duke of Orleans, to let him establish a state bank that would issue paper currency backed not by gold or silver, but by the authority of the French crown. He then merged this bank with a trading company, the Mississippi Company, that held monopoly rights over the vast French territories in North America. Music. Law's system was breathtaking in its theoretical elegance. By issuing paper money and using it to pay down government debt, by funneling that money into the Mississippi Company and driving up its shares, Music, by using the rising shares as collateral for more currency issuance, Law believed he could simultaneously resolve France's ruinous national debt and create an engine of economic growth that would propel the country into a new era of prosperity. Music, for a time, it seemed to be working. Mississippi Company shares rose from 500 livres to 10,000. A new word entered the French language, millionaire. But the system had no floor, Music. When investors began to quietly convert their paper money into gold, when trust in the currency began to falter, the whole architecture collapsed. Music, the shares fell. The currency fell. Law fled France in disguise, his fortune confiscated, his reputation in ruins. The Mississippi Bubble and the South Sea Bubble burst in the same year on opposite sides of the channel, Music teaching the same lesson in two languages, that financial systems built on confidence can expand with astonishing speed and can contract just as fast, and that the distance between the two is often nothing more than a rumor. Back in London, the business of trading continued, legally cloudy but practically unstoppable. Music. Jonathan's Coffee House gradually became more formal. In 1761, a group of brokers formalized their arrangement, creating rules for membership and a clearer structure for how trading would be conducted. Music, in 1773, they moved to a new building and renamed it the Stock Exchange, the first formal use of that phrase in English. A decade later, it moved again to a purpose-built exchange hall in Capel Court, which would be its home for nearly 2 centuries. Music, the London Stock Exchange was not yet the institution it would become, but it had found its name and its form. Across the Atlantic, a new nation was struggling with the same questions Europe had been wrestling with for centuries: how to manage debt, how to fund growth, how to create an orderly market for the instruments of commerce. Music. The United States emerged from the Revolutionary War deeply in debt. The new federal government had borrowed heavily to fund the conflict, and Alexander Hamilton, the first Secretary of the Treasury, had a bold plan for dealing with that debt. Music, he proposed that the federal government assume the debts not only of the national government, but of all the individual states, issuing new bonds to replace the old ones. It was a financial masterstroke that would bind the states to the federal government through shared financial obligation, Music, and it created, almost immediately, a market for trading those bonds. The Buttonwood Agreement of 1792 is often cited as the founding moment of the New York Stock Exchange, though the truth is a little more complicated. Music. On May 17, 1792, 24 stockbrokers and merchants signed an agreement beneath a buttonwood tree, a sycamore on Wall Street in Lower Manhattan. Music, the agreement was simple. They would give preference to each other in their trading, and they would charge a minimum commission of 0.25%. It was not a founding charter or a formal constitution. It was a trade agreement designed to protect the broker's business against competition from the public auction markets that were then the main venue for securities trading. Music, but it established a relationship and a community that would grow over the next 2 centuries into the most important financial marketplace in the world. In the years following the Buttonwood Agreement, the market in New York traded mainly government bonds and bank stocks. Music. Young American Republic needed banks, and banks needed capital, and capital came from investors who bought shares. First Bank of the United States, the Bank of New York, the Bank of North America. These were the major companies of the early American market. Music, their shares changing hands in the coffeehouses and on the street corners of Lower Manhattan. It was a small, intimate world. Everyone knew everyone. Prices were set by negotiation, and rumor as much as by any formal mechanism. Music, but it was enough of a market to support the financial needs of a growing nation. The Industrial Revolution changed the scale of everything. Beginning in England in the late 18th century and spreading to the United States and continental Europe through the 19th, industrialization created a demand for capital that dwarfed anything that had come before. Music, factories required machines. Machines required iron and coal. Iron and coal required mines and furnaces. And more than anything else, the industrial world required railroads, the network of steel tracks that would bind continents together and make possible the movement of goods at speeds and volumes that would have astonished any previous generation. Music. Railroads were the great speculative vehicle of the 19th century. Music. Building a railroad required enormous upfront capital, land acquisition, engineering surveys, earth-moving, track-laying, the purchase of locomotives and rolling stock, years before any revenue would flow. Music, no individual or small partnership could finance this. It required the joint stock company form, it required many investors, and it required a stock market willing to absorb and trade those shares. In England, the railway mania of the 1840s saw hundreds of railway companies formed, their shares bought by investors from every social class. Music, from aristocrats who saw the new technology as a sound investment to small clergymen and shopkeepers who mortgaged their futures on shares they barely understood. The mania, like all manias, ended in collapse. Music. Many of the hundreds of railways proposed were never built. Many that were built could not generate enough revenue to justify their construction costs. Shares that had been sold at premiums collapsed to fractions of their issue price. Music, thousands of investors lost everything. And yet, and this is always the hardest thing to hold in mind when looking at financial manias, the railroads that were actually built were real. The iron rails in the ground, the stations, the locomotives, music, the bridges over rivers and through mountains, these things remained, and they transformed economic life in England and eventually everywhere the railways reached. The speculation was irrational. The underlying thing being speculated on was genuinely world-changing. Music, both of these things were true simultaneously. In the United States, railroad development followed a similar arc but on an even larger scale. Music. The Transcontinental Railroad, completed in 1869 with the driving of a golden spike at Promontory Summit in Utah, was funded by a combination of government land grants, government bonds, and private capital raised on the New York Stock Exchange. Music. The companies that built it, the Union Pacific and the Central Pacific, were among the largest corporations in the world at the time of their construction. Their shares were actively traded, their bonds held in portfolios from Boston to London. Music, the financial machinery that made the Transcontinental Railroad possible was the same machinery that had financed Dutch spice voyages, Italian banking networks, and British canal companies. A machinery of shared ownership, distributed risk, and secondary markets where ownership could be easily transferred. Music. The New York Stock Exchange grew rapidly in the decades after the Civil War, propelled by the explosive growth of American industry. Steel companies, oil companies, telegraph companies, and later telephone and electric companies all came to market during the Gilded Age, the decades between the end of the Civil War in 1865 and the turn of the 20th century. Music, men like John D. Rockefeller, Andrew Carnegie, and J.P. Morgan accumulated fortunes of a scale that had no precedent in American history, and they did so using the stock market as a source of capital for expansion, as a tool for acquiring competitors, and as a mechanism for converting business success into personal wealth. Music. J.P. Morgan, in particular, understood the stock market as a tool of power as much as profit. Morgan was a financier rather than an industrialist. He did not build railroads or make steel, but he reorganized companies that did, cutting through the chaos of competing interests to impose the order he believed was necessary for efficient business. Music, his reorganizations, called Morganizations by contemporaries, sometimes admiringly, sometimes bitterly, typically involved buying out weak holders, restructuring debt, replacing management, and restoring confidence in companies that had failed or were failing. Music. In 1901, he organized the creation of U.S. Steel, the first company in American history to be capitalized at more than $1 billion by buying out Carnegie Steel interests and merging them with others. It was the largest business transaction anyone had ever seen. Music, and it was conducted through the stock market. The invention of the stock ticker in 1867 changed the rhythm of market information forever. Music. Before the ticker, news of prices traveled slowly, by word of mouth, by messenger, by the time-lagged columns of daily newspapers. A trader in Philadelphia had no way of knowing what prices had done in New York until hours after the fact. But music, the ticker, a device that printed price data on a narrow paper tape as it flowed in over telegraph lines, changed this. For the first time, people across a wide geographic area could watch prices change in something close to real time. Music, the ticker tape, became an icon of financial culture, its constant clicking the soundtrack of market life, its paper streamers tossed from windows to greet returning heroes. The immediacy of price information it provided accelerated trading. Music increased speculation and began to draw ordinary citizens into the drama of daily market movements in a way that had never been possible before. The panics of the 19th century were brutal teachers. The Panic of 1873, triggered by the collapse of J. Cook and Company, a major railroad financier, set off a depression that lasted years and destroyed thousands of businesses. Music. The Panic of 1893 was worse in some ways, driven by railroad overexpansion, currency disputes, and a sudden loss of confidence that cascaded through the banking system. The Panic of 1907 was stemmed only by the personal intervention of J.P. Morgan himself. Music, who locked the city's banking leaders in his library and refused to let them leave until they had agreed on a plan to support the failing institutions. These crises each left marks: regulatory changes, institutional reforms, and most importantly, a deepening understanding. Music, of how connected the pieces of the financial system really were. The Panic of 1907 made the case, finally, for a central bank. The United States had no central bank after the first Bank of the United States was dissolved in 1811. For nearly a century, the American banking system operated without a lender of last resort, a financial institution that could step in during a crisis and provide liquidity to prevent the kind of cascading failures that turned a bank run into a national depression. Music. The Federal Reserve System, established by the Federal Reserve Act of 1913, was the answer to this gap. It created a network of regional reserve banks. Music. Coordinated by a central board, empowered to set interest rates, regulate the money supply, and in times of crisis, lend to banks in trouble to prevent panic from spreading. Music. The Federal Reserve would face its first great test sooner than most of its architects had anticipated. The years after the First World War were years of extraordinary optimism in America. Music. The economy was expanding. Technology was transforming daily life: automobiles, radio, electric light, refrigerators. A new consumer culture was emerging, fueled by installment credit that allowed ordinary Americans to buy things now and pay later. Music. And the stock market was rising. Not slowly, as markets rise in normal times, but dramatically, the kind of rise that attracts not just investors but speculators, not just the wealthy but ordinary working people who had never thought of themselves as part of the market at all. Music. The Roaring Twenties were not just a cultural phenomenon, they were a financial one, and the stock market was at their center. Margin trading, borrowing money to buy stocks, using the stocks themselves as collateral, became widespread during the 1920s. Music. An investor with $100 could buy $300 or $400 worth of stock, amplifying both potential gains and potential losses. As prices rose, more people borrowed more money to buy more stock, which drove prices higher, which attracted more investors, which drove prices higher still. Music. The market was not simply reflecting economic reality. It was running ahead of it, fueled by the belief that the prosperity of the 1920s would continue indefinitely, that technology and efficiency had made the old business cycle obsolete. Music. That there was, as one prominent economist declared in the autumn of 1929, a permanently high plateau for stock prices. There was no plateau. Music. On October 24, 1929, a day that would become known as Black Thursday, the New York Stock Exchange opened to a wave of selling that swept through the market with bewildering speed. Music. Prices fell sharply. Crowds gathered outside the exchange building on Broad Street. Margin calls went out to leveraged investors, demanding they put up more cash or have their positions liquidated. Music, many could not meet the calls, and so their stocks were sold, driving prices lower, triggering more margin calls, forcing more sales. A spiral had begun. The crash continued through October and into November. Music. By mid-November, the Dow Jones Industrial Average had fallen nearly 50% from its September peak, but even that was not the bottom. The market would continue to decline in waves, for nearly 3 years, music reaching a low in July 1932 that was more than 89% below the 1929 peak. Billions of dollars of paper wealth had been annihilated. Thousands of banks had failed. Unemployment had risen to 25%. Music, the Great Depression, the worst economic catastrophe in modern American history, had arrived, and the stock market had played a central role in both the euphoria that preceded it and the devastation that followed. The lessons drawn from the crash shaped American financial regulation for the next half-century. Music. The Securities Act of 1933 and the Securities Exchange Act of 1934 established, for the first time, a federal framework for the regulation of the stock market. Music, companies wishing to sell shares to the public were now required to disclose financial information in a standardized form, verified by independent auditors. The Securities and Exchange Commission, the SEC, was created to enforce these rules, to investigate fraud, and to bring cases against those who manipulated markets. Music, Glass-Steagall also passed in 1933, separated commercial banking from investment banking, on the theory that banks should not speculate with the deposits of ordinary customers. The Federal Deposit Insurance Corporation was created to insure deposits, music ending the bank runs that had been such a destructive feature of every previous panic. The New Deal financial reforms did not end financial crises, but they changed the texture of them. Music. The period after World War II was characterized by relative financial stability, the era economists call the long post-war boom. Music. The Bretton Woods system, established in 1944 by a conference of allied nations, created a framework of fixed exchange rates tied to gold through the US dollar, providing a stable international monetary environment. Domestically, the New Deal regulations kept financial speculation at lower levels. The SEC watched the markets with genuine attention. Music, and the memory of 1929, still vivid for anyone who had been an adult then, acted as a cultural break on the most exuberant excesses. The stock market rose through this period, but sedately, in keeping with the genuine growth of the underlying economy. The cultural relationship between ordinary Americans and the stock market shifted gradually through the 1950s and 1960s. Music. The post-war prosperity created a large middle class with savings to invest. Mutual funds, pools of many investors' money managed by professionals, made it possible for small investors to own diversified portfolios without needing to pick individual stocks. Music brokerage firms began to court the ordinary saver with advertising campaigns that presented stock ownership as a civic virtue, participation in American economic growth, a sensible part of any household's financial planning. Music, the New York Stock Exchange's own campaign, Own Your Share of American Business, ran for years through the 1950s and 1960s, reaching millions of households. Music. The 1960s brought a new generation of investors and a new era of speculation. Go-go years of the 1960s were characterized by mania for growth stocks, companies in new industries that might generate spectacular future profits. Music conglomerates, holding companies that assembled unrelated businesses under a single corporate roof, were fashionable. Their managers celebrated as geniuses who had discovered a formula for perpetual growth through acquisition. Mutual funds managed by celebrity stock pickers attracted billions in new investment. Music, the market rose dramatically through most of the decade, then stumbled badly in the early 1970s when inflation, the oil crisis, and the end of the post-war boom combined to produce a bear market that erased years of gains. Music. The 1970s also saw the end of the Bretton Woods system when President Nixon severed the link between the dollar and gold in 1971. This decision, made under pressure from trade imbalances and the costs of the Vietnam War, ended the era of fixed exchange rates and ushered in the age of floating currencies. Music, it also began a period of significant financial experimentation. Without the anchor of gold, exchange rates, interest rates, and commodity prices became more volatile. That volatility created both risk and opportunity. Music, and a generation of financial engineers set to work developing new instruments for managing and exploiting the new uncertainty. Options, futures on financial instruments, currency swaps, and eventually the vast complex of derivative contracts. Music, that would come to define late 20th century century finance. All of these grew out of the volatility of the post-Bretton Woods world. The 1970s also produced the index fund, one of the most consequential and underappreciated innovations in the history of investment. Music. The idea behind the index fund was simple, and it came from academic research rather than trading floors. Studies of mutual fund performance have been showing consistently that most actively managed funds where professional managers pick stocks based on research and judgment, did not outperform the market average over time. If most managers couldn't beat the market music, the most efficient thing for most investors was simply to own the market, to hold a diversified basket of stocks that mirrored the overall index. A fund that did this would have much lower costs than an actively managed fund, because it didn't require highly paid analysts or portfolio managers, music, and those lower costs compounded over years would translate into meaningfully better returns for the investor. John Bogle, the founder of Vanguard, launched the first index fund available to retail investors in 1976. Music. The fund was initially derided by the investment industry. Critics called it Bogle's folly, an admission of defeat, a fund for people too lazy to do the work of picking winners. Music, but the data was on Bogle's side. Over the following decades, as index funds outperformed the vast majority of actively managed alternatives, the investment industry was forced to reckon with an uncomfortable truth. The market was harder to beat than it looked. Music, by the early 21st century, index funds would hold trillions of dollars and would have quietly transferred enormous amounts of wealth from the financial industry, which profited from active management fees, to ordinary investors. Music. The 1980s were years of transformation, and they changed the culture of finance as profoundly as any decade since the 1920s. Music. The Reagan administration came to power in 1981 with a philosophy of deregulation, a belief that markets worked best when regulation was lightest, that the reforms of the New Deal era had grown into a thicket of rules that stifled innovation and efficiency. Music. Key financial regulations were loosened. Savings and loan associations were deregulated in ways that allowed them to take on risks for which they were poorly equipped. The boundary between commercial and investment banking, already eroding, was pushed back further. Music. The result was an era of financial creativity, new instruments, new institutions, new strategies that generated enormous wealth for those at the center of it and laid the groundwork for the crises that would follow. The 1980s also saw the rise of the leveraged buyout, a technique for acquiring companies using borrowed money. Music. Private equity firms, led by legendary figures like Henry Kravis and leveraged buyout pioneer Michael Milken, the junk bond king who would later go to prison for securities violations. Music discovered that they could take control of large public companies by borrowing money, often against the assets of the very company they were buying. The acquired company could be made more profitable by cutting costs, selling divisions, or simply growing under different management. Music, the returns could be spectacular. The logic was seductive. The execution was sometimes brilliant and sometimes brutal, and the people who lost their jobs and restructured companies did not always share in the gains that were celebrated on Wall Street. Music. October 19, 1987 is known as Black Monday, the single largest one-day percentage drop in stock market history. The Dow Jones Industrial Average fell 22.6% in a single day, a decline larger even than any single day in 1929. Music, the causes were complex: overvalued stocks, rising interest rates, trade deficits, and a new phenomenon called program trading, in which computers were programmed to automatically sell stocks when prices fell to certain levels. Music, creating a self-reinforcing cascade that accelerated the decline. The market recovered relatively quickly, more quickly than after 1929, in part because the Federal Reserve, under its new chairman Alan Greenspan, immediately promised to provide liquidity to keep the financial system functioning. Music. Black Monday raised a question that had been lurking since the dawn of the computer age. What happens when machines make decisions faster than humans can intervene? Music. The answer to that question was still being worked out, because computers were only just beginning to transform the mechanics of trading. Music. For most of the stock market's history, trading had been a physical activity. Human beings stood on trading floors and called out prices to each other, or wrote orders on slips of paper and handed them to clerks. Information moved at the speed of human speech and human legs. Music. The introduction of computer networks into trading floors in the 1970s and 1980s gradually began to change this. Prices could be transmitted faster. Orders could be executed with fewer intermediaries. Music. The trading floor itself, that noisy, physical space where dealers made markets by shouting at each other, began to seem like a relic. The 1990s were the decade of the technology boom, and the stock market was its largest stage. The internet was commercialized in the early 1990s, and it immediately attracted investors who believed it was the most transformative technology in human history. Music, they were right about the technology. They were not always right about the valuations. Companies with no revenue, no profits, and sometimes no clear business model attracted investments of hundreds of millions of dollars. Music, the Nasdaq Stock Exchange, which had always had a higher proportion of technology companies than the New York Stock Exchange, became the symbolic center of the boom. Its composite index rose from under 800 in 1994 to over 5,000 in March 2000, a gain of more than 500% in 6 years. Music. The stories from that era are simultaneously inspiring and cautionary. Amazon, founded in 1994, went public in 1997 at $18 a share. Music, it lost money for years, and critics repeatedly questioned whether it would ever make any. But its founder, Jeff Bezos, was building something enormous, and investors who held through the volatility eventually saw extraordinary returns. Music, Petscom, founded in 1998, raised over $80 million in its IPO in February 2000, spent lavishly on advertising, including a famous Super Bowl commercial, and went bankrupt in November of the same year. Music, the difference between Amazon and Petscom tells you something about the gap between a real business and a pitch, though in the late 1990s, the market had considerable difficulty telling the two apart. The dot-com bubble burst in March 2000, and the Nasdaq fell nearly 80% over the following 2 years. Collapse was painful, especially for the millions of ordinary investors who had put their savings into technology stocks at elevated valuations. Music, but it was not catastrophic in the way that 1929 had been catastrophic, because the leverage that had amplified the Great Depression's damage, the margin loans, the bank exposure to equity markets, was less pervasive in 2000. Music, the financial system was hurt, but not broken. Many of the technology companies that survived the crash, Amazon, Google, which went public in 2004, and others, went on to fulfill some of the ambitions the boom had imagined, on timelines that proved longer than speculators had hoped. Music. The decade between the dot-com crash and the financial crisis of 2008 was a period of dangerous calm. Property prices were rising across the United States, fueled by low interest rates, loose lending standards, and a belief that real estate never truly fell in value. Music banks were bundling mortgages into complex securities and selling them to investors around the world, distributing risk, or so the theory went, in ways that made the system safer. Music rating agencies awarded high credit ratings to instruments whose actual risk was not well understood. Regulators, shaped by decades of deregulatory philosophy, assumed that sophisticated financial players would manage their own risks responsibly. Music. The assumptions were wrong. When property prices began to fall in 2006, the mortgages underlying those complex securities began to default. Music, the securities, which had been rated as safe, proved to be highly vulnerable to falling home prices. Banks that held them or that had insured them began to suffer losses that quickly became existential. Music. In March 2008, Bear Stearns, one of the oldest investment banks on Wall Street, was sold in a crisis transaction to JP Morgan Chase for $2 a share, having been worth over $150 a share a year earlier. In September 2008, Lehman Brothers, 158 years old, one of the most storied names in American finance, filed for bankruptcy. Music. It was the largest corporate bankruptcy in American history. The stock market fell sharply. The Dow Jones Industrial Average lost over half its value from its 2007 peak to its March 2009 low. Music. But the more frightening element was what was happening in the credit markets, the markets where banks lend to each other overnight, where the basic plumbing of the financial system runs. Music. Those markets froze. Banks stopped trusting each other because no one knew which institutions held how much toxic debt. The Federal Reserve, the Treasury Department, and central banks around the world took extraordinary steps to prevent a complete collapse. Music, providing trillions of dollars in emergency lending, guaranteeing bank debts, taking equity stakes in failing institutions. The Troubled Asset Relief Program, TARP, authorized the Treasury to buy or insure up to $700 billion of troubled assets from financial institutions. Music. The rescue was controversial. It was, in the view of many ordinary Americans, a bailout of the people who had caused the crisis, using the money of those who had suffered from it. Music. That anger was real and understandable. and it did not fade quickly. It shaped the politics of the following decade in ways that are still being felt. Music, the Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in 2010, was the most significant financial regulatory overhaul since the New Deal, tightening capital requirements, creating new oversight bodies, and attempting to address the too-big-to-fail problem that had made the 2008 bailout seem unavoidable. Music. The market recovered from the crisis, slowly at first, then with increasing confidence, and finally with a momentum that became one of the longest bull markets in American history. Music. From the March 2009 low to the February 2020 high, the S&P 500 rose more than 500%. A decade of low interest rates, engineered by central banks to support recovery, pushed investors into stocks in search of returns that bonds could no longer provide. Music corporate profits grew. Technology companies, led by Apple, Amazon, Microsoft, Google, and Facebook, achieved valuations that placed them among the most valuable entities that had ever existed. Music, the FAANG stocks, an acronym for these giants, became the defining investment story of the 2010s, just as railroads had defined the 1860s and internet startups had defined the 1990s. Electronic trading transformed the physical reality of stock markets almost beyond recognition. By the 2010s, the famous trading floors of the New York Stock Exchange and the Nasdaq were largely ceremonial. Music, the actual matching of buyers and sellers, happened in computer servers in data centers in New Jersey, executing millions of orders per second with no human intervention. High-frequency trading firms, companies that use sophisticated algorithms and extremely fast network connections to trade in and out of positions in microseconds. Music accounted for a significant fraction of total trading volume. They did not hold stocks for years or months or even days. They held them for fractions of a second, profiting from tiny price discrepancies that existed for no longer than the blink of an eye. Music. This transformation raised philosophical questions about what a stock market was actually for. Music. In its original form, the stock market was a mechanism for connecting people with capital to the businesses that needed it. Music, a company could sell shares to the public, use the proceeds to build something, and then the investors who had provided that capital could share in whatever resulted. The secondary market, where shares were traded between investors, served this primary purpose by making investment liquid. If you could sell your shares whenever you needed the money back, you were more willing to buy them in the first place. Music, but high-frequency trading had nothing to do with capital allocation or long-term investment. It was arbitrage, pure and simple, the extraction of small profits from the difference between prices in different markets at the same instant. Music, whether this activity added value to society or merely extracted it, became a genuine subject of debate. The arrival of commission-free trading and smartphone apps in the late 2010s brought a new wave of retail investors into the market. Robinhood, founded in 2013, made it possible to buy and sell stocks and options on a phone with no commission and no minimum account balance. Music, it reached millions of younger investors who had never had a brokerage account, drawing them into a market that had previously seemed, to many young people, like something that belonged to older, wealthier generations. Music, the COVID-19 pandemic, which began in March 2020 and sent the stock market into a brief but violent crash, also accelerated this trend. Stimulus payments, time at home, zero interest rates, and the ease of mobile trading combined to bring millions of new participants into the market in a very short period. Music. The GameStop episode of January 2021 was one of the most remarkable events in stock market history. Music. GameStop, a brick-and-mortar video game retailer, was a company that most Wall Street analysts had written off as a declining business in a world that was rapidly moving to digital downloads. Music, large hedge funds had taken significant short positions against it, betting that the stock price would fall. But a community of retail investors, coordinating on Reddit's Wall Street Bets forum, Music decided to buy the stock en masse, with the explicit goal of squeezing the short sellers. The short squeeze worked. GameStop stock rose from under $20 to a high of nearly $500 in a matter of weeks. Music hedge funds that had shorted the stock suffered billions in losses. The retail traders who had bought at lower prices made fortunes, though many who bought near the peak suffered significant losses when the price eventually collapsed. What the GameStop episode revealed was something that observers of markets had always known, but rarely seen demonstrated so dramatically. Music, that markets are not purely rational mechanisms that efficiently process information and arrive at true values. They are also social phenomena, contests between narratives, arenas where collective emotion and coordinated action can move prices far from any reasonable assessment of underlying value. Music, the 18th century Dutch tulip traders would have recognized the dynamic even if the forum was different. The South Sea shareholders of 1720 would have understood the feeling, the intoxicating sense that everyone else was winning and you were missing out. Music. The history of the stock market is in many ways a loop. Music. New technologies arrive. New investment opportunities open, enthusiasm builds, speculation rises. The market runs ahead of reality, confidence breaks, prices fall, investigations fall, regulations change, and the cycle begins again, with new technologies, new opportunities, new enthusiasms. Music, the specific content changes in each cycle. The underlying psychology does not. Human beings are not perfectly rational calculators of expected value. They are social creatures who take cues from each other, who find it hard to sell when everyone around them is buying, and who find it hard to buy when everyone around them is selling. Music, the market reflects this. It always has. Passive investing has gradually shifted power from professional managers to ordinary investors in ways that are still unfolding. Music. John Bogle's index fund idea, dismissed as folly in 1976, grew into one of the most important financial developments of the late 20th century. By 2019, for the first time in history, more money was held in passive index funds than in actively managed American stock funds. Music, the implications of this shift are significant. If more and more investors simply own the index, holding every company in proportion to its size, then the mechanism by which prices are set by the judgments of active investors becomes less robust. Music, questions about whether passive investing can distort valuations, concentrate corporate voting power in the hands of a few giant fund managers, or reduce the efficiency of capital allocation are active areas of research and debate. Music. The stock market of the 21st century is global in a way its predecessors never fully were. Music. Capital flows freely across borders at the speed of a transaction. A pension fund in Norway can own shares in a semiconductor manufacturer in Taiwan, a software company in India, and a consumer goods company in Brazil, all of which can be bought, sold, and rebalanced with a few keystrokes. Music, the emerging markets of Asia, Latin America, and Africa have developed their own stock exchanges, connecting local companies to global capital. The Bombay Stock Exchange, the Shanghai Stock Exchange, the Nairobi Securities Exchange, Music, all carry forward the basic idea that began in Amsterdam in 1602, that ownership can be divided and shared, that the risk of building something real can be distributed among many strangers who will never meet. Music. The environmental, social, and governance movement, ESG, represents a new dimension of thinking about what stock ownership means. For most of stock market history, the relationship between an investor and a company was purely financial. The investor provided capital, the company used it to generate profits, and the investor received a share of those profits. Music, the company's impact on the environment, on its workers, on its community. These were, in the traditional view, externalities, considerations that might matter politically or ethically, but were not the investor's proper concern. Music, ESG investing challenges this view. It argues that companies that treat their workers well manage their environmental impact responsibly, and are governed with integrity are likely to generate better long-term returns, not despite their ethical practices, but because of them. Music, the debate about whether ESG improves returns or represents a constraint on them, or whether it is genuinely transforming corporate behavior or merely providing cover for greenwashing, is a live and contentious one. Cryptocurrency and blockchain technology raise the most fundamental questions yet about the future of the stock market as an institution. Bitcoin, invented in 2009 by the pseudonymous Satoshi Nakamoto, introduced the idea of a decentralized, trustless ledger, a record of transactions that existed across thousands of computers simultaneously, without any central authority to verify them. Music, the implications for financial markets were immediately apparent to some observers. If transactions could be recorded and verified without a central intermediary, then perhaps the exchange itself, the institution at the center of stock market history, from the Amsterdam Wars to the New York Stock Exchange, was not strictly necessary. Music, decentralized finance, or DeFi, is an attempt to build financial services, lending, trading, even derivatives on blockchain networks without traditional intermediaries. Whether these experiments will ultimately replace or simply augment traditional financial institutions is a question that remains genuinely open. Music. What is clear is that the stock market has always evolved, never staying in the same form for long, always being reshaped by technology, by regulation, by the failures that created new rules, and by the opportunities that created new instruments. Music, the open-air meetings of Dutch merchants in the 17th century gave way to the formal exchange building. The physical trading floor gave way to electronic matching engines. Commission-based brokerage gave way to commission-free mobile apps. Music, the next transformation is already beginning, though its full shape is not yet visible. The stock market has survived wars, depressions, technological disruptions, and its own recurring tendency toward mania and panic. Music. It has survived because the underlying need it serves is real and persistent. Human beings have always needed a way to pool their resources for large undertakings, to distribute the risk of uncertainty, and to create a mechanism for turning future expectations into present-day value. Music, every instrument in the market's history, the bill of exchange, the joint stock share, the futures contract, the bond, the derivative, is an attempt to solve one of these problems. Some solutions work better than others. Some create new problems in the process of solving old ones. Music, but the attempt continues because the need continues. The ordinary investor of the 21st century stands at the end of this long chain. When you open a brokerage app and buy a share of stock, perhaps without much thought, perhaps as part of an automated retirement contribution, you're participating in an institution that is more than 400 years old in its recognizable form, and far older in its essential nature. Music, you are, in a small way, doing what the weaver in Amsterdam did in 1602 when she put her savings into the VOC. You are sharing in the ownership of something larger than yourself. You are accepting, in exchange for the possibility of gain, music, the reality of uncertainty. You are joining the vast, ongoing conversation between strangers about what things are worth and what the future might hold. It is a conversation that began in ancient port cities and continues today across screens and servers that encircle the globe. Music. It has been shaped by brilliance and greed, by panic and patience, by the slow accumulation of rules designed to make it fairer and the recurring discovery that rules are always imperfect. Music, it is not finished. It will never be finished, as long as human beings need to organize their efforts across time and uncertainty, and as long as they need to convince each other to take on shared risks for the possibility of shared rewards. Music, the stock market is not a building or a computer or a set of rules. It is a set of relationships of trust and risk and expectation, stretched across centuries, across continents, across the whole complicated history of how human beings decided to work together. Music. As we come to the end of our journey, you might notice how the stock market feels now, not just as a place where numbers go up and down on a screen, but as a living record of human ambition, fear, ingenuity, and resilience. We began in the ancient harbors, where merchants pooled their grain and shared their risk, and we traveled through the canals of Amsterdam and the coffeehouses of London. Music, through the panics and manias and reforms that shaped the institution century by century, through the crash of 1929 and the recovery that followed, through the revolutions of electronic trading and the arrival of billions of ordinary investors who changed what the market meant and who it was for. We watched it break and be rebuilt, drift toward excess and be restrained, and grow to a scale its founders could not have imagined. And through all of it, we saw the same essential impulse, the human desire to build something larger than any one person can build alone. If you are still awake and you would like another slow journey through the past, there will be a next video waiting for you on the music screen. You can simply let it play and keep following the thread of discovery wherever it leads. And if this episode brought you calm curiosity, you might like, music, subscribe, or leave a comment. It helps the channel reach more listeners who need a softer place to land. But for now, you do not need to navigate music anything at all. Let your jaw unclench, let your music shoulders drop, feel your breathing find an easier rhythm in and out like a tide music that knows exactly where it belongs. Imagine the last light fading behind a quiet horizon and somewhere across the water, a merchant ship moving steadily homeward through the dark, its hold full of everything that was risked,